the silver market is a much smaller market than the gold market. If they sell gold, people are going to buy some of that money will go into the silver market, and that will accelerate the silver price to a high degree. So I think silver will do at least as much as gold. But what about if this doesn't happen and there's no special revaluation of gold? Do I think silver will rise? Well, according to the Silver Institute, we can see the supply and demand of silver since the last few years has been in deficit. As that deficit gets larger and larger, more and more recycled silver, i.e. you and I melting down or taking our gold, or in this case silver, taking our silver in to be melted down, is going to have to happen. Otherwise the silver won't be there. And the only way they're going to suck it out is with the higher prices. So I think silver does go higher, whatever happens.
Imagine waking up one morning to the news that gold has been officially revalued to $15,000 an ounce. Clive Thompson, whose remarks on this subject are gaining attention, says if the Treasury stood as buyer of last resort at that price, the reaction would be instant. Holders of gold would rush to exchange it for dollars. Once in hand, those dollars wouldn't sit idle. They'd flow into other assets, and silver, with its much smaller and tighter market, would be one of the first beneficiaries. The spillover effect could send silver soaring even faster than gold. But Thompson points out that silver doesn't need a gold revaluation to justify a bull case. Its fundamentals are already strong. The Silver Institute reports that the market has been running supply deficits for several years. Mine output continues to decline, while industrial demand, particularly from electronics and renewable technologies, remains steady or rises. As deficits widen, higher prices will be required to attract additional supply. The structural imbalance is already baked in, and it points upward. In 2025, the silver market is projected to remain in deficit, albeit narrower than in the previous year. Even so, a deficit remains a deficit. It means demand is exceeding supply. For investors, that's a setup with only one logical outcome: prices adjusting higher to restore balance. Meanwhile, Thompson's argument for gold revaluation returns to the reality of debt. On paper, U.S. gold reserves are valued at just $42.22 an ounce. At $15,000, they'd suddenly be worth trillions, giving the Treasury a stronger balance sheet and buying time in a system weighed down by unsustainable interest costs. Whether that policy shift occurs or not, the message is clear: both gold and silver have a compelling case for significantly higher prices in the future. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
First of all, on this scenario, if they do put up the price to $15,000, and it might not be in one go, but let's say they were to do that, and they're standing as buyer of the last resort at that price, on day one, there's going to be an awful lot of people tender their gold to the Treasury. And what are those people going to do with that gold, with that money that they get? They're immediately going to buy other things, and silver will be one of those things. Now, the silver market is a much smaller market than the gold market. If they sell gold, people are going to buy some of that money will go into the silver market, and that will accelerate the silver price to a high degree. So I think silver will do at least as much as gold. But what about if this doesn't happen and there's no special revaluation of gold? Do I think silver will rise? Well, according to the Silver Institute, we can see the supply and demand of silver since the last few years has been in deficit. In other words, not enough is coming out of the silver mines to meet the demand for industrial use and other uses. So the extra silver which is needed to meet those needs has been coming out of recycled silver. And that explains why we've seen a rising price of silver, because as the price of silver rises, more silver gets recycled to balance the books. The deficit, according to the Silver Institute, and I've got no other source to go on, is going to grow larger. The reason it's going to grow larger is that the mine supply of silver is still in decline, and the industrial usage of silver is still on the rise, especially from electronics, where it's rising very rapidly. So as that deficit gets larger and larger, more and more recycled silver, i.e. you and I melting down or taking our gold, or in this case silver, taking our silver in to be melted down, is going to happen. Otherwise the silver won't be there. And the only way they're going to suck it out is with the higher prices. So I think silver does go higher, whatever happens. That there's an awful lot of people out there who think, I'd just like to have some $350,000 gold bars in my basement, just in case.
Sure.
It could be. it seems like a funny thing to want. If you're worried about Armageddon, you'd probably want to have smaller coins. Because these bars which are being delivered are very expensive bars, my assumption is that it's large players who think that physical gold, is going to be hard to lay their hands on in the future, and think that if they have any sort of paper gold, they might not be able to get it at all and might lose the value of that in some way, shape, or form. So I'm guessing that it might be a government or governments. So what government might want to lay their hands on gold in New York? Well, it could be Mexico, it could be Canada. Canada's got no gold apparently, but it could be China. But obviously China, I think that would be a bit of a giveaway if they were buying it through New York. They'd probably buy it through London. But we have seen China buying every month. They bought again. They're not buying a great deal, but they're buying, I think, 60,000 ounces in the month of July and 70,000 ounces in the month of June, and before that 60,000 ounces a month. Sorry,
European countries would be my hunch, Clive.
That's certainly a possibility, but there are other possibilities out there. It might be a bunch of hedge funds or a particular hedge fund who's making a very large bet.
Yep.
They're taking it in, they're storing it, they're putting it away in a safe place. Maybe they're storing it at COMEX, I don't know.
Yeah, that makes sense.
And they expect to make a large profit when there's a revaluation of gold. I mean, we mustn't forget, hedge funds are very rich and powerful people and very well connected to the kinds of people we've been talking about, the people who are in the know about what's going to happen. So if they know something, it'd be a great idea to take physical delivery while you still can. I've been trying to get clarification on both. One, the question of whether these bars be tariffed, and two, whether that was misinformation. Obviously, it's widely reported that it is misinformation and there's no tariffs, and I believe that it's widely accepted there won't be. That's what I'm reading on all the reputable financial news sites, but none of them are quoting an actual document, which so I haven't been able to find that. But let's assume that it's correct, that there'll be no tariffs on gold bars. Well, what's happening then are those shorts who were panicking to buy back their futures and panicking to buy spot gold in New York while they could still get their hands on it, suddenly are now unwinding their positions. So they're selling the gold in the spot market and shorting again at the long end. So I think we're in a little bit of disarray, and that might explain why the gold price didn't rocket upwards yesterday on the news of this half-point cut, or quarter of the half-point that Scott Bessent wants. A few days ago, before the Labour report last week, which was a terrible report from the jobs numbers point of view, the expectation was that it was about 70% probability of a rate cut in September. That immediately moved to around 90%. But since Scott Bessent spoke last night, the probability of a rate cut in September has now moved to 100%. That's according to the CME FedWatch, which does the mathematics of this. So the question is no longer whether we'll get a 0.25% cut in September. It's how much will the cut be? Is it going to be a quarter or is it going to be a half? And now the market, well, obviously, stock markets are overjoyed with that news. And you saw, the Dow went up by 400 points yesterday. We're speaking today on Thursday. I don't know when you're going to broadcast, Thursday, the 14th of August. So yesterday, the 13th, the Dow went up and the Nasdaq went. They all hit, the Nasdaq hit all-time records. The S&P 500 hit an all-time record. Gold moved a little bit, but gold is in a little bit of disarray at the moment because of the events of last week regarding the possible tariffs on gold bars.
Yes, comments on that, Clive.
So one of the Swiss refiners wrote to the US Customs to say, can you just please clarify that the tariffs will not apply to gold bars? And the answer came back saying, well, probably apply. I haven't seen the text of the answer. I don't know if it's published even. But the answer came back along the lines of something like, well, 100-ounce bars and kilo bars will be tariffed, but not the 400 kilo bars. Well, of course, what's needed in New York are the 100-ounce bars, not 100 kilos. What's needed in New York are the 100-ounce bars. What's coming out of London to be refined are the 400-ounce bars. So the bars go from London to Switzerland to be refined from 400 to 100 and from Switzerland to New York. So that the fear was that 100-ounce bars would be tariffed at 39%, which immediately drove the futures to a huge premium because on COMEX in New York, there are a lot of shorts. And those shorts are consistently selling the futures. They've got the gold in London. Yep, no problem. They're fully covered in a certain sense, but they consistently roll the gold forward month after month. They buy back the spot month and roll it into the future month. But suddenly there's a worry that what if they have to deliver? Up until now, the thought's been, well, I've got the gold in London. I can always deliver if I need to. But now the fear, or the fear became when this happened, oh my God, perhaps I won't be able to deliver. So these shorts rush to cover their long position in the futures market, pushing up the futures to a very large premium compared with the spot market. And of course, there was a scramble to buy gold at the spot level. Then there was a clarification, I believe, from the president, and I haven't seen that actually, but I see it reported everywhere. There's a clarification saying, oh no, that's all a big misinformation. There won't be any tariffs on gold bars. Without having seen the text of either, and I say, I don't, I've been looking for it. I don't know if it's published. Have you seen it, Daniela?
Clive Thompson highlights a quiet yet telling trend in the gold market. Large players are taking delivery of massive gold bars. These aren't the small coins that retail buyers tend to pick up. We're talking about high-value bars that only governments, central banks, or extremely wealthy institutions typically deal with. The implication is clear. These buyers want physical control, not paper claims. Some speculate that countries with thin or even zero official reserves, such as Canada or Mexico, may be moving to establish a base. Others think hedge funds are making bold bets on an eventual revaluation. Either way, the preference for physical delivery signals a more profound mistrust of the financial system. At the same time, gold markets have been unsettled by confusion around rumored tariffs. Reports circulated that new tariffs on gold bars were being considered, sparking a wave of knee-jerk reactions. Most reliable sources now agree that no such tariffs are coming, but the mixed headlines created enough uncertainty to rattle traders. That may explain the odd market response to the Federal Reserve's latest rate cut. Usually, a move like that would trigger a strong surge in gold. Instead, the reaction was muted. Thompson suggests shorts may have scrambled to cover during the tariff scare, giving gold a quick lift only to re-enter positions once the story faded. The result is a market caught in a temporary state of disorder. Let's get back to the interview.
Well, let's start with the price. Obviously, 15,000 was a number which I thought would be appropriate, but I've seen many arguments both for higher numbers and lower numbers, and I'll discuss how I got to a 15,000 level. But let's just go back a step and look at why it could be very beneficial to the United States to revalue gold. The United States is running record budget deficits. The debt is rising rapidly, and it is likely that the interest to be paid on that debt is going to rise very fast from here. We've seen the interest expense as a percentage of the receipts, the government receipts, i.e. the taxes it's taking in, rise from 3 years ago, just 8%. In other words, they were taking in taxes of, let's call it taxes of 100 and paying 8% in interest, and the rest was used for other government purposes, to this year, 18.6%. So it's more than doubled, certainly more than doubled in 3 years. Now, according to not only my calculations, but the Congressional Budget Office's calculations, that number is going to continue to rise for the foreseeable future. The only comment I'll make is the CBO is almost certainly being too conservative in their numbers, because they are assuming an interest rate which is unobtainable, i.e. far too low, unobtainable if you're a borrower at the moment. So the government has a large amount of debt maturing in the next 4 or 5 years. I think it's something like 9 trillion, which a lot of that debt was taken out when interest rates were 1 to 2%. And they're going to have to roll it over at higher rates, which are closer to, I'm going to say closer to 5%, although 4.2% wouldn't be an unreasonable rate at the moment. That will cause the amount of interest being paid on the national debt as a percentage of the tax take to be actually worse than this 22.6% that the Congressional Budget Office sees for the year after next. And it's going to spiral up quite a rapid pace beyond that. And there comes a point when it becomes completely unsustainable. So something has to be done to at least put the debt in check or reduce it or slow down. And I think one of the options, and by the way, this is not the only option, Daniela, but I think it's a very attractive one for the United States, would be to revalue gold at a higher level than the statutory price. Now, the statutory price for gold was set in, I think, originally was set when they raised it from $25 to $35 in 1934. And then I think they raised it again in 1972 and 1973 to now $42.22 an ounce. So the gold that the United States holds is on their books at a price of $42.22. And the Federal Reserve, who does not own the gold, but has a gold note representing the gold they did sell to the Treasury, a gold note which is worth $11 billion, priced at the original price of $42.22. Now, that gold note or gold certificate is not convertible into gold by the Federal Reserve. It just represents legal tender of $11 billion, even though it's called a gold certificate. Meanwhile, the Treasury's got the gold, which they've got on their books at $11 billion, but it's really worth $700–800 billion today. If we take a market price, today's market price, I think it's somewhere between 3,300 and 3,400 as we're doing this show. Might be a little bit higher in a few days. That would release $750 billion, and I'll explain how if they were to revalue it. Now, there's several ways in which this can be done, and I'm also going to get to why 3,300, 3,400 is not the right number, why a higher number would be the appropriate one, the 15,000, which I talked about. But I just start with the basic principle that they go to the current market price of gold, and then we'll go from there as to why the higher number will be better.
Sounds good.
So there's broadly speaking, two ways in which this can be done. The first one was outlined in the Bitcoin bill, Bitcoin Act, which hasn't passed into law, but basically that Act specified, as a subclause of the Act, the Federal Reserve would tender its gold certificates of $11 billion to the United States, in other words, to the Treasury. The Treasury would then immediately revalue gold to the current price. In that Bitcoin Act, they referred to $3,300. And then the Treasury would reissue to the Federal Reserve gold certificates identical to the previous ones, but at the current market value, which would be $700–800 billion. And the Federal Reserve would be obliged, on that happening, to pay to the Treasury the difference between the value of the two gold certificates. In other words, a bit more than $700 billion. Now, the beauty of this, and by the way, this has already happened effectively in 1934 anyway, so it's just a repetition of the same old trick, same old. Now, the beauty of this is that the gold certificates are not part of the national debt. In other words, when you see the national debt, that includes bonds issued by the government, notes issued by the government, treasury bills issued by the government, but it does not include the gold certificates. So in swapping 11 billion of gold certificates for 750 billion of gold certificates, the Federal Reserve would have to pay to the Treasury the difference, $700 billion, without increasing the national debt. In fact, the Treasury gets the $700 billion, $750 billion, and it can use that money to reduce maturing debt, and obviously, because it's revalued the gold, it will show a huge profit, at least not as much to cover the budget deficit, which of $2 trillion, but it'll cover a third of the current year's deficit, bringing the deficit for the current year looking like it's not rising as fast as it really is. The gold certificates are effectively perpetual instruments, a bit like a banknote. They're perpetual, they're zero coupon, the government pays no interest on these gold certificates, and they can't be redeemed by the Federal Reserve, not for gold, not for cash, not for anything, unless the Treasury says so. So that would help a little bit if they did it at the current price of 3,300. But what I suggested was perhaps they should choose a different number, and I suggested the right number might be $15,000 an ounce. There are a lot of people that are saying, well, Why not revalue gold at $150,000 an ounce and pay off the entire national debt? I think that's a dangerous strategy because it's going out a little bit too far into very untested territory. The figure I proposed of $15,000 would generate cash for the Treasury of $3.9 trillion. Now, that's not a terribly big number of cash relative to the national debt of $37 trillion. It's about 10% of the national debt. And it's not a terribly big number relative to the amount of increase in debt they have every year, which is around $2 trillion, slightly more. So it's a little bit adventurous. But the market can absorb that extra $3.9 trillion with no problem at all. I mean, after all, $3.9 trillion is smaller than the size of Microsoft. It's smaller than the size of Nvidia. It's smaller than the size of several companies on Wall Street. So that would be $3.9 trillion of new cash coming into the Treasury's hands, which would allow the Treasury the ability to retire some of the debt which is maturing this year and next year, and show not a deficit for the current year, because the deficit is going to be $2 trillion roughly, but it will show a profit of $1.9 trillion on its budget for the current year.
What no one in Washington is discussing is the idea of turning Federal Reserve notes back into real dollars, redeemable in gold or silver. That silence speaks volumes. Any so-called revaluation being floated isn't about restoring sound money. It's about inflating away obligations and weakening the currency to buy time. On the speculative side, there has been chatter that the federal government might invest nearly $750 billion in Bitcoin. For its fans, that would be the ultimate stamp of legitimacy, Washington declaring crypto a reserve asset. But the odds are slim. The U.S. establishment is far more comfortable with tools it can influence or control, and Bitcoin doesn't fit that mold. Meanwhile, other nations are charting their paths. Norway and Saudi Arabia, for instance, have established massive sovereign wealth funds that hold a diverse range of assets, including oil fields, real estate, and shares in blue-chip companies. These funds operate like national savings accounts, investing excess revenue into hard and financial assets to preserve wealth for the future. Could this accelerating preference for hard assets mark the early stages of a financial reset that reshapes how wealth and credibility are measured on a global scale? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Additionally, if you are interested in Bitcoin-related news, consider subscribing to our other channel for more updates. Thank you for the support, and I hope you enjoy the video.